All right, let's do this again. Let's run it back, boys. We're live again because I didn't realize the FOMC minutes were today when I went live this morning. We are here with March's FOMC minutes, the Open Market Committee. Their inside notes, their behind closed doors thoughts, reactions, feelings, opinions about the FOMC meeting in March. And these have actually had some interesting information for us over the last few meetings. We heard them for the first time refer to potential hikes in interest rates if inflation didn't continue cooling or if inflation heated up. We've heard some talks about tariffs and policies and things for the first time in these. We've actually had spice. They haven't been complete nothing burgers. So let's hope that this one is more of that, more of the juicy goodness. I already have it fed into AI because we went live a little late. I got it all set up here. So let me jump into it. While I'm doing this, I appreciate you tuning in. We cover the FOMCs, the minutes, live charts, and trading all the time here on YouTube. So I'd like it if you could take a minute, hit the like button, subscribe, put a message in the chat, join the crew, and let's get into it. Let's do the fun stuff. The fun stuff. Let's see, the key policy decision. Let's get in here. Developments in financial markets and operations. But basically, the Open Market Committee kept the target range unchanged. There were no changes during the last meeting. This was not a surprise. We had already seen probability markets, Fed tool, interest rate predictors, 100% basically price in no interest rate change. So that was no surprise. All members, all but one member, supported this decision. Yes, the single dissenter, we also get to hear about the dissenters in the minutes, was Marin. He was looking for a 25 BPS cut and argued that policy was too restrictive and contributing to weak labor demand, which may be true, could technically be true, as we have not seen, we haven't seen good job numbers. Seen for the last year. I believe that was the last FOMC where Powell said the entirety of last year was net negative for jobs. Maybe the stance is too restrictive. He didn't say that part, but maybe we can see what Marin is going for there. The post-meeting statement emphasized data dependence, as it always does, elevated uncertainty, which Lord knows they didn't even know about Iran at this point. Jesus, right? Did they? When did this start? I'm losing track of time. I'm going insane. I told you guys that earlier. I'm going insane. I think we're all going insane. The next meeting will be at the end of the month during Bitcoin conference, actually, 28th through 29th. We're going to be obviously covering that. You're going to be here. It's mandatory. It's going to be an awesome time, as it is Chairman Powell's last FOMC ever. Unless my bet comes true. I'm betting that through all odds, through all the impossibility, that somehow Powell just ends up being the Fed chair again. We'll see. It's still ongoing. We're still waiting for that. To my knowledge, no one's confirmed. We've heard names, but no one's locked in. So don't miss it. It's going to be wild. It's going to be historic for us. Economic. Where are we? Staff review of the economic situation. Real GDP expanded at a solid pace, adjusted for Q4 government shutdown effects. Private domestic final purchases, which is a better signal of underlying momentum, strengthened. Indicators pointed to continued solid growth through Q1 of 26. Unemployment rate was steady at 4.4%, and that's the same as Q4 readings in September of last year, so unchanged. Job gains remained low or negative. Some softening signals appeared, like slight raises in prime age unemployment, concentration of job growth in healthcare and few other sectors, AI, etc. Declining survey measures of job availability. Most participants viewed the labor market as broadly balanced, though vulnerable to shocks. I guess it's broadly balanced, if they say so. Inflation remained elevated. Our 12-month PCE inflation average was 2.8% in January and was estimated the same in February. Core PCE was 3.1% in January and 3% in February. Here we go. 50% above the 2% target. Core goods inflation picked up, partially due to tariffs. Housing services inflation slowed, but non-housing core services remained elevated. Financial markets. Sharp rise in oil prices. No surprise. Due to Middle East conflict, higher near-term inflation expectations, and some repricing across assets. Equity prices fell 5%. The software sector was hit harder by disruption in AI concerns. Treasury yields rose, especially at the short end, and premiums increased. The dollar strengthened modestly on safe haven flows and U.S. net exporter energy status, though it has lost some of that strength since then. Money markets remain stable and reserves ample. The staff review of the financial situation and participant outlook. Growth is expected to run roughly in line with potential through 28. Unemployment rate staying near current levels before edging down slightly towards the longer run natural rate. Inflation slightly higher near-term forecast due to oil prices, tariffs, policy, but projected to decline towards 2% by the end of 2027 as those effects fade. That's actually kind of dovish. Didn't expect that. Higher productivity, AI deregulation, is seen as disinflationary source by some of the members. I don't know if we see it yet. I think the only disinflationary force on it so far is people losing their jobs. But I'm not convinced that will be a long term. We'll see. Risks remained elevated, and uncertainty overall remained elevated as well. Upside risks to inflation increased compared to the prior meetings. Persistent energy prices, possible de-anchoring of longer-term expectations. The downside risk to employment and growth. So we have an increased risk to inflation and a downside risk to employment and growth, and that puts us in a weird spot. A low hiring environment makes labor more vulnerable. Potential business caution around AI and geopolitics. Participants noted that a prolonged Middle East conflict could keep energy prices higher, slow disinflation, and weigh on sentiment and hiring. I'm really losing my mind. It was March that this all started. Dude, new things keep happening and replacing the old things. It's becoming impossible to just like have a timeline or I don't know, keep track of it all. Policy discussion highlights the most viewed the current policy rate as roughly in the range of the neutral after last year's 75 BPS easing. The committee stressed it would remain nimble and data dependent as it always does. Many expect eventual rate cuts if inflation continues to decline, but several pushed back on the expected timing and saw a possible case, this was the big thing, for future hikes if inflation stays persistently high. There's no preset course as always, and decisions will be meeting by meeting. Pretty much they're on hold. They're watching the conflict in the Middle East and its impact on oil prices. The biggest factor at this point, kind of it's like the Fed's having trouble keeping track of everything too. Everything else is thrown basically to the back because oil's impact on inflation can be so great. Inflation progress has begun to stall recently. That's true. We've seen those numbers not go the direction we expect them to. Labor demand soft and uncertainty remains high. Policy's positioned to respond flexibly in either direction. Is that the main gist of it? Is that it? Is that all you're going to say? That's not all of it. Grok, you're doing a bad job. Bad AI. See, this is why I'm saying that. This is what I'm saying that our jobs, I don't know if they're going to replace jobs permanently, because like I feel like that was the best job. Let's see. See if I can prompt her up, get a little more. This is a lot of notes. This is a lot of minutes. No, these aren't correct. There's the one dissenting vote. New to this meeting. Okay, yep. So At the meeting, the conflict was new. I literally was like, that started this month, but that can't start this month. Also, I moved and had all that crazy stuff going on for the last few weeks, so I'm extra time logged. The conflict triggered a sharp, about 50% surge in crude futures, pushing near-term inflation expectations up, of course, while longer-term measures stayed anchored. Logical. Longer-term measures unlikely going to be that impacted by whatever's going on today, almost no matter what, unless a lot of oil refineries start getting blown up. Markets repriced aggressively, higher rate policy expectations, no cut fully priced in until December of this year. 30% chance of hikes early next year. That is new. That is interesting. We were really looking at least one hike, I think, or at least one cut. If it's supposed to be like 3 or 5 cuts, really, at some point last year into this year. Now it's down to 1 or maybe a hike. That's a big reversal. Rising short-end treasury yields, falling equities, 5% drop, modestly stronger dollar. Yeah. The notes definitely introduced fresh uncertainty, which is interesting because I think the last notes they were talking about uncertainty being at the highest levels. Now, again, at the highest levels. Participants explicitly flagging as elevated both upside risks to inflation and downside risks to employment. That seesaw upside downside risk is a newer concept here and definitely a hard one for the Fed to accurately unravel. Ripple effects were broad. Foreign central banks now expected to hike instead of ease. Higher global inflationary pressures give the potential for more persistent energy price pass-through if the conflict drags on. The tone change. Inflation. Near-term forecasts were bumped higher for inflation, definitely looking more hawkish. Talking about rhetoric about the 2% progress towards the 2% target slowing. That's also pretty hawkish. Before this meeting, they were talking about tariffs pushing up prices, but now oil is clearly going to be in the driver's seat. Doesn't matter what else is going on. If the price of oil continues to increase and remain elevated, inflation is going to follow. There's no way around it, period. Staff lowered their activity outlook. Participants noted the conflict could soften business sentiment and hiring in an already low job gain environment. Committee stayed pretty stout on holding rates, with just Marin dissenting, emphasized nimbleness. Yeah. Long story short, that the Middle East is the new shock, and it reframes pretty much the entire near future outlook and risk balance. That is certainly going to be talked about more come the FOMC in April. It's undoubtedly going to be the most important thing going on. That was a pretty quick wrap up. We were already live today, and actually I have a plumber coming soon. I did want to cover these minutes. I know that people weren't that hyped for them today. I didn't even remember that they were today. But I did want to cover them. I did it really fast. I do appreciate you guys tuning in. Oh, man. Yeah. But I'm gonna do this rare one. I'm gonna end it really early. I'm glad you tuned in for these 13 minutes. Hopefully you got some value. Mark it on your calendars. April, it's the 28th. It's the last Wednesday, the 29th. Last Wednesday this month. The final 𝐒𝐴𝐺. The final 𝐒𝐴𝐺. You got to be here. Make sure you've liked and subscribed. Jump into our free Discord, discord.gg/TomCrown. Sign up with our partners in the video description below. If you do, you'll get free VIP roles in the Discord. And I will catch you guys on Friday. Crown out.